Thank you very much for everybody joining us today. We're delighted you've been able to sign up for this webinar. We've specifically invited our partners, our agents that support us and help us, promote our products to different clients. So this is purely a presentation about Germany for you guys. So if you have any questions throughout the webinar, please do fire them into the question box, and we'll deal with them at the end, just to keep things moving. We're going to be talking about Germany, obviously. We've been investing in Germany for, a number of years. The first development we did was back in 2015, central Berlin. So Germany's not a new market for us. As you can see on this slide, we've done a lot outside of the UK over the years since we were founded in 2006, starting in Asia and sort of heading over to the US. And we sort of migrated back to Europe and done a lot in the UK during some boom years for the UK market. But we are an international company, and we are actively sourcing investments in Germany, and we're also looking for developments in Portugal. Watch this space, because we hope to secure something in Porto, which we hope to launch in the coming weeks or months.
I think the other thing to say about particularly why we're going to talk about Germany today is the current inflationary environment, which is affecting everywhere in the world, really. And a lot of our partners, a lot of a large slice of their focus is on the UK because it's one of the most transacted markets in the world. But in particular, we think Germany, which we've been doing for 9 years now, 10 years almost, I think, that represents a lot of safety and a lot of benefits, which we'll go into a bit more now. Particularly with mortgage rates that we're seeing high in the UK at the moment, those people who might be exposed to the British pound might want to take a bit of euro exposure as well. A lot of this today will be explaining just how positive and how secure investing in Germany can be. So maybe a bit of a hedge against other investments they've got or other property they've got in different markets.
Exactly. So just a little bit of an agenda. We're going to cover why Germany and talk a little bit about the economic stability in the country. We always get asked, do you do developments in Munich? Do you do stuff in Frankfurt, the cities in the West? And we don't, and we're going to talk about why. We're going to cover off the non-resident mortgage options for investors, relevant taxes, the security behind the structures, and how we invest in off-plan properties in Germany safely. And then we're going to cover at the end a little bit on Berlin and Leipzig, which are our two favorite cities, and then questions.
So, starting from a macro sense, in a climate like this, really a property investor, wherever they're buying in the world, should be looking for stability. We still want to find that growth. We still want to find good yields and so forth. We want to find an environment which is predictable in the long term, and Germany really reflects that. It's the fourth biggest economy in the world. It's by far the biggest in Europe now that the UK has left the EU. It represents 25% of the entire GDP of the EU. It's a very large population, 83 million, and a national GDP of 3.9 trillion, depending who you listen to. It's anywhere between that and about 4.4. So it's got a varied industry sector. So we're not just reliant on, a lot of people think about cars in Germany, and that is a massive player, but they are also in healthcare, pharmaceutical, electricity, and mechanical engineering, and a lot of these service-led industries, with tech starting to kind of flood in, particularly in the East, actually, a lot more these days. They're the kind of industries which are going to be safer over the long term. So, in all, this means a good environment for a predictable pattern of behaviour, basically over the long term. And of course, it's politically stable compared to most places in the world. Its national debt is very low, 77% of GDP. That's 12% lower than the average, and most major economies in the world that you'd think of as big players, they are all a lot higher than that. And its employment rate is one of the world's highest, particularly for a developed economy at 77.3% overall. So, all these things add up to mean extra safety overall. And so, fine, we understand the country then makes sense. The euro's in a fairly decent position against the dollar. Then where then in Germany would you consider? And as Will said, a lot of people's first thoughts might well be to some of the big names we've been thinking about. We know Frankfurt is a large, finance hub in Germany, and Munich and Hamburg are big entities in their own right. But they have been very successful. They're very well developed, and finding value in those markets is a lot trickier. And so what we're going to be looking at, and what we have been looking at, to great success over the last 9-10 years, is the East. We started in Berlin originally, and then about 5 years ago we started to move to Leipzig. And effectively, going to the East is a story of reunification of Germany. It was East and West, and in 1989 the wall came down, and what had been a much poorer half of the East, naturally a lot of their residents migrated out. They had free access now. They could move to Hamburg and Munich and so forth, and they decided, yeah, fine, we'll go and chase those jobs. There was actually a huge drain in the eastern cities of Leipzig, Dresden, and Berlin there, but which remained big, important cities. But there was a period of kind of slight economic collapse there and instability. And essentially, since 2000, what we've seen is a rebuilding of this economy and a filling of that vacuum. Big business has decided actually it's a good idea to be putting headquarters there, because Berlin is the center of politics in Germany. So a lot of big business want to be near to influence in the center of politics. Leipzig, just an hour south of Berlin, is a big, traditional trade crossroads from literally going back about 1,000 years. So these are large cities on size and scale, but the opportunity there is for a changing of the guard and a redevelopment of their whole industries. So the industries which might have collapsed in the late 80s and 90s, a whole new redevelopment of tech, of energy and healthcare and sciences and so forth. That's what's really been prospering. So as business is really pushing there, because they can get cheaper rents for their leases on their properties, and rents for residents are cheaper there. What we've seen then is a faster speed of growth in the East, and still a massive capacity for faster speed of growth than their sister cities in the West. And so that, coupled with some major players in market like the electric car industries in Germany moving there, and a lot of the tech and a lot of startups in Germany all really kicking off in the East now, this is where we're seeing a higher GDP growth that we can find in other cities, and therefore all knock-on effect, a safer market for property, as we're seeing a flood of people coming in, and a brighter outlook effectively for property prices to keep going further forward.
Yeah, I mean, thinking about it, the East wasn't even a sort of place you could buy. It wasn't really a free market in any way. And some of this data, no doubt you've all been looking through as Jeremy's been discussing it, is interesting. I mean, the bottom blue bar graph shows you where salaries were. The average salary in the West in 1991 was 21,900 odd euro. Fast forward to 2019, that had increased to 37,000 euro. So that's the West. But if you look at the East, it was very low in 1991 at 11,000 euro for the average salary. And now, as of 2019, it's 31. So the gap is really closing. So that's where a lot of the wealth is shifting. And we still see a lot of value in the East, and people have now got the money that they can afford to buy and rent property, and that's putting pressure on house prices. And
it's rare to the point of almost never happens to find that kind of opportunity in a developed market, and so this is only because of the post-war unification and then de-unification of reunification of the market, that we see this as an anomaly essentially. So for the next 15-20 years, the markets are catching up to where they rightfully should be in market, and that's what value is.
Exactly. And going back to the wider scale, Germany is very unique. It joined the euro, and it's sort of wrapped up in some of the euro's challenges economically and with unemployment and some of the issues. So it has a cheap currency. It has to have fairly low interest rates. It's not fully in control of those two things. So that's again an interesting play on the fourth largest economy in the world, when you can buy its currency at a fairly cheap rate. But you can buy currency, but you can also borrow currency. And that's important because we want to leverage these investments. And that does restrict what we do at IP Global, because if we can't borrow money from a local bank, we generally don't go and invest in that country, because our investors want to leverage, they want to maximize their returns, and that's how you make money through properties. So there are lending options in Germany. We do think that they will continue to grow. Inward investment and international investment into Germany is growing, and banks are still fairly risk adverse to lending to non-residents, but there are a handful of banks, and we have sort of obviously direct links to those lenders. So just some sort of key differences, perhaps just comparing the UK market. Firstly, we deal generally with buildings that are under construction. That's when we like to get involved and secure some good value for our clients. At that very early stage, we're able to go to our lenders and actually secure our mortgage then. We're able to know the loan to value, we're able to know the interest rate, and that contract and that agreement to borrow that money is signed at the very beginning. So the lender approves the building, the lender approves the construction schedule. It's not like where you go and apply for the mortgage on completion. One of the key differences, and removes a little bit of risk that some clients don't like. The construction schedule, you can actually borrow that. The way that it works typically is that there's payments linked to how the building is progressing through construction, and the lenders will actually allow you to borrow that money and pay those payments as the building is built. Lending is still very competitive. The 10-year fix is currently 3.91. I think this is going to creep up just over 4% in the next couple of weeks. We had confirmation from a couple of lenders, but borrowing at around this level for a 10-year fix is still extremely competitive, and lower than the UK at the moment, obviously. So just some key differences there. Anything to add there, Jeremy?
I think everything was very clear there, but it's just the direct comparison to a lot of people will be offering clients property in the UK, and it's still a very strong market in the long term. But of course, in the very short term, the base rate of the central bank in London being 5.25 now, it's very difficult to find mortgages for cheaper than the cheapest we've seen really at the moment. It's probably high sixes, and a lot of the mortgages are coming out at 7 and 8 at the moment, which fair enough will be kind of not long term. We expect them to come down by the end of next year. But to be able to pick up a 10-year mortgage in a developed market like this at 4% and have that locked, so you don't have to worry about this kind of thing in future. You don't have to worry about inflation or the rates going up. You have a 10-year fix there, which you can marry with your cash flow and be very secure. Then all you really have to worry about then is getting your tenant in there and having rental escalation over time. Having that kind of cheap mortgage in a really secure market is a really good reflection, and it's a position, frankly, I feel is what everyone should be looking at the moment, because that's again, it's safety.
Yeah, and it's being able to sort of we deal with a lot of Brits and we deal with a lot of Europeans, and we do get objections about investing into Germany, and we always wonder why, because from a pure investment point of view, this all makes a lot of sense. What makes also a huge amount of sense is some of the tax benefits. So you're probably aware that the government in the UK have been playing around with stamp duties, and there's the surcharge for buy-to-let investors, there is the non-resident surcharge as well, and there's the original ban. So it all gets firstly quite complicated to explain. But it's also that the more you invest, the sort of higher the percentage you actually pay in stamp duty. And that's hurt the top end of the market quite a bit. And it's actually meant that a lot of investors are coming in at the lower end of the market, which is fueling the market and pushing first-time buyers away from buying. So government policy never sort of seems to fix the problem in the UK. But you have a different land transfer tax, stamp duty in Germany, and it depends on which tax federal state the property you're purchasing is in, depending on whether it's going to be as low as 3.5 or as high as 6. So it just depends on where it is. Income tax, everything is still deductible. So all of your interest costs are deductible, all of your running costs, and there's also a depreciation allowance that you can apply as well, given the asset needs to be maintained. So the taxman allows you to take off a little depreciation off your annual income. So again, compared to the UK, where they've been reducing the amount of interest that you can deduct if you're a higher tax rate payer, it's very compelling. And again, if you do qualify for the allowance, which is just under €11,000, our view would be, why not take it? You know, if you can earn income in a country from rental and not have to pay tax on it, why would you not go and explore that, especially if you're paying income tax in other countries? And the big play, and talked about a lot with our sort of genuine kind of expat clients, I call them, is that there's no capital gains tax if you hold the property for 10 years in Germany. You can sell 3 properties in a tax year and not pay tax, not pay capital gains tax, basically. So very compelling. And if you buy a project through us that's under construction, it's ready in a year or 18 months, that's when the clock starts ticking.
When you notarize contracts is when the clock starts ticking. So, you know, the property can be delivered 18 months, 2 years later, but actually you're already, you know, a couple of years into your 10 years. So, yeah, it's very much a medium-term play for 10 years here. It doesn't mean you can't sell, of course. You know, effectively, if you sell any time before 10 years, it'd be just like selling the property you owned in the UK. You're just going to have to pay capital gains tax on it. But it's you'd be mad to do that if you possibly could hold on for the 10 years, basically, because being able to save, you know, most markets with their capital gains brackets are going to be somewhere in the region of about 25% or so. You might be able to deduct a few things, but that's a large proportion of your overall profit. So, you know, we'll see later the percentage return on equities for a property in Germany, because of basically no income tax on your rent and then no tax on your profits at the end. That's an enormous boost to your overall returns.
Yeah, and if you look at other countries where there are sort of aren't poor English, sorry, but where there isn't capital gains tax, you know, they're generally emerging markets, up and coming countries where there's risk. And here you're investing in the 4th largest country in economy in the world, the powerhouse economy of the EU and Europe, and you have that tax benefit. So it's massive. Security of investment, we're always looking at this. We're always looking at what can go wrong, what are the risks, you know, what are the potential outcomes, and that's again something that's very powerful in Germany. So we talked about the mortgage structure and how you're sort of able to remove that risk when buying off the plan. There's a notary that sits between the seller and the buyer. So in most cases, the buyer and the developer, and that notary will be responsible for making sure that the construction milestones have been met, and then your payments that you pay as the building is built are invoiced correctly and match obviously the schedule that's written out in the contract. So that's a nice comforting thing to have in the agreement. The payment plans that the developers go to market with means that we take a product out there, we sell it in a few weeks. The developer has everybody's mortgages lined up. They have to evidence their equity. The developer can then invoice for the building. So we see very secure investments financially. We don't see developers running around trying to scramble money together to find completion monies to build projects. And the key thing here, I'd say that if a project comes to market, it is 99.999% times going to be delivered on time. And that is because there is rental compensation built into the contracts, so that if the completion date, which is always the short stop date, is met and the developer still hasn't handed over the keys and completed on the building, they have to start paying rental compensation. So in Berlin, that's typically €15 per square meter. In Leipzig, it's actually a little bit less. It just depends on the rent in that area. So that's a very secure thing. And we just don't see developers coming to market with schemes that they can't finish on time for that obvious reason. The UK has leasehold and freehold, and there's good reasons why. It dates back to sort of old British and English law, well, not British, English law, slightly different in Scotland. But in Germany, you have a strata ownership structure. So as a buyer of an apartment in Germany, you own that apartment, but you also own a share in the company that owns the land and owns the buildings. So again, you could say it's a little bit more secure, and Europeans are very used to that kind of model.
Yeah, I think we touched on it, but just in case it wasn't hugely clear, in terms of the mortgages, which we know are cheap there, in terms of the safety of their structure, we will get people to get their mortgage offer fully approved before they even notarize contracts. So maybe a month after they originally reserve a property, then you can get your full mortgage offer contractually signed off. So even if a property takes, 18 months, 2 years to deliver, that's locked in. So there's no kind of seeing where the market is. come completion time. It's something that you have tied a bow on. You've got that basically contract with the bank basically already. So if people are at all worried about changes in market and where things are going to be in the next 2 years, being able to lock in 4% and knowing it's there, even if the property's not delivered yet, that's a huge bonus. So we put this in, actually, obviously PwC, it's a big consultancy everyone knows of around the world. They do their index for top cities in the world for investment, and they use a range of things for their scoring. And just put in this year's really just to give a view that they consider Berlin to be third this year. London actually has kind of come up. It hasn't been in the top 5 much in the last 5 years, but obviously see a bit of value there. But the point here is actually, if you look back literally the last 10 years, Berlin is the only city which has been in the top 3 every year of that. There's the latent value of this big city. We can bear in mind this is a big city on European standards. Like a lot of people might know it's a fun place to visit for a weekend and so forth, but it's at 3.7 million, it's only second behind London in terms of population. And the big consultancies and the banks and so forth, the talk really of Berlin is becoming one of Europe's mega cities, one of the world's mega cities, up by 2040. So there's so much interest and power and investment going on there that it's likely to be one of the most important centres of commerce in Europe, certainly for the decades to come. And if we compare then Berlin, because a lot of people will know a lot of the big cities in Germany, and this is the big 8 as they call them. And what we're looking here is GDP growth basically from 2000 up to 2020, and then predictions for 2020 up to 2035. And we can see, what Berlin is actually much bigger than any of the others. And, you'd be forgiven for thinking that maybe Munich was ahead, but that size of city, the actual latent business and everything they have there, it's already a massive player. But what we would like to see is, and we can see both Leipzig and Berlin, from now until 2035, they're both expected to see the biggest GDP growth in terms of percentage over that next 12 to 15 years or so. So as much as they have been performing really well and playing a lot of catch up, the ongoing expectation is their GDP growth will be outstripping those of the more established Western cities. And so who is there? What are the jobs? What's happened there? As I said before, this change of industries basically kind of from the turn of the millennium, energy, transport, healthcare, information, media, these are all, relatively future-proofed in investment areas, employment areas. And it's a nice broad array of them. So we can see, hundreds of thousands of people in this. And then also you've got things like your manufacturing and so forth as well. So it's what we want to see in terms of diversity of the economy and those industries which are in a growth sector. And just to mention a handful of the major investments which have been coming into market of late. Berlin-Brandenburg Airport, it's relatively insane to think that the capital of Germany up until 2019 didn't have a fully functioning international airport. It had a smaller airport, which is that site being redeveloped now for office space. But Brandenburg is an airport with a 50 million passenger per year capacity. So now, just over the last couple of years, you can fly direct from Middle East and China, and it's the capital of Germany is now accessible. And we've seen this time and time again with other cities in the world. When you open up direct routes, Manchester, maybe 8 years ago, the level of investment suddenly starts spiking, particularly from the east. So it's an enormous boost, and so that airport's just 30 minutes south of the city centre. Rolls-Royce recently.
I mean, the airport, Jeremy, it's massive to think that they haven't been able to travel into, you haven't been able to get to New York and Hong Kong and only around Europe from Berlin. And also, don't forget, Berlin is a very heavily visited city by tourists. So it's going to really open the door for further tourism as well as commercially.
Yeah, exactly. Just adding to that upward pressure on market. Um, the other ones, particularly to mention, I suppose Tesla, a massive name, in Brandenburg, which is just on the outskirts of Berlin. It won the tendering to get Tesla's Gigafactory. So they're going to be the major manufacturing plant of Teslas in Europe, and also they won about a lot of countries in the world were vying for getting Tesla's battery factory, which is going to be in the same place there. So, and this is a reflection of this wave of tech and digital companies setting up in the East, because there is land which is affordable there compared to the West. So they like the environment of Germany, but the value is in the East. And so, centering basically between Leipzig and Berlin, we're seeing a lot of these big, Intel has got a chip factory there. And, it's the kind of business we want to see, good, well-paid engineers, good tenants, and, a lot of money coming into market. And then Aldersdorf Science Park there, that's a 2.8 billion scheme as well, which is in the south of Berlin, which is has been developed of late.
And all of these businesses are able to, as Jeremy said, they're able to operate in the East and potentially in Berlin as well as Leipzig at a fraction of the cost. And they're also able to employ, a young workforce now. And if you look at graduate salaries, that's interesting because now Berlin actually offers the highest graduate salary out of all of the top 8 cities, and it didn't used to. You've got 180,000 students in Berlin, and historically, they live a fairly cheap lifestyle, get educated in Berlin, and then move on to one of the big cities. Whereas now, the jobs are actually in Berlin, and that's where these young people are staying, and that's why we've got such a modern economy that's so built for the future in tech and in industry.
Yeah, I think there was the stats come out about a couple of years ago saying 75% of all the startups in Germany were happening basically in the East, but particularly in Berlin and Leipzig there. So a vast proportion of these new companies being set up in the East. Just a few more examples here of some of the major investment, and we look at the kind of the spend going on here. This is very much on a global city scale. Tegel Airport redevelopment, that was the airport I mentioned. That's a 12 billion regeneration plan for homes and offices and student housing and so forth. So that's a whole new town site, basically, just to the north end of Berlin. Siemensstadt is Siemens, the company we all know. That's based in Germany there, and they've got their basically Siemens Village, which they've been halfway through construction, basically, and that's going to be a lot of their HQ is based. Europa City, that's actually in the heart of Berlin in the finance district, and that's I think it's about a 17-hectare area, which is being redeveloped into high-end office space. You can see KPMG, PwC, SAP, Total. They've got their head offices in that area, and then we've got the Köpenick train station was a redevelopment, and that's just representative of what's been going on all over the city. We mentioned that one specifically because that's an area we've been focusing on. Bought a property there recently.
So if you have a look at this, just more data, we love all this data because it supports the investment case. Top left, you've obviously got population and population growth, which is very strong. And then on the bottom, you've got economic growth, and you can see how the economy has risen in Berlin from, what is that, 9 billion, 90 odd billion euros, and it's right up to somewhere over 160 billion today, and predicted by Oxford Economics to grow up to 350 billion by 2040. So the economic predictions by the independents are very strong. And then on the next slide, we should have some data around housing supply. Now, we talked about how the east of the country was in decline. We've talked about how we had a lot of people move west when the Berlin Wall came down in 1989. And for that reason, very little property was built over that sort of 10 or 12 year period where there was economic decline. Of course, developers weren't interested in building because they potentially couldn't really sell the units. There wasn't the demand because the population had left. So very little was built. And now that we've got this migration back that's coming from the West, there is a chronic shortage of housing, which is why there's been attempts to impose things like rent caps and all pieces of absurd law, because the market is going up. And that is because of supply. So again, you have one of the most undersupplied capital cities in the world when it comes to housing supply, and you have one of the fastest growing cities economically. So there's a lot of good reasons that support property value growth. Just a little bit more there. You can see it's staggering, isn't it? Unemployment peaked at 19% in the early 2000s. And, you know, that's come way down in the capital city to, I think it's about 7.6 or something. And again, predicted to taper down to about 5%. So I think that's just a really interesting stat, that you have unemployment that reached that high, and it's come down that quickly, as well as with an increasing population at that time as well.
We see that the average household disposable income with that therefore means it's booming. So more people have more money in their pockets. It means a more competitive market, both for rents and for buying property, and so just more upward pressure on the market overall. And, you know, because of then a massive undersupply of units in market, that means that, you know, we've got the pressure basically still. So, you know, 90,000 units deficit, that's a lot of property they're not building.
Yeah. And you can see here, there's been a lot of growth. We've been involved in this. We've got a lot of clients invested around the city fairly centrally. And over the last 5 years, the average has been 8.1% year on year in terms of capital value growth. And then if you look at rental growth, it's very strong, 8% average year on year growth. And the vacancy rate is unbelievably tight. I mean, 0.9% is sort of unheard of. And that's simply people just moving in and out, which takes a week or two. So, you know, you've got some strong figures. And what we're really going to come onto here is to answer the question that you're already thinking now is, have I missed the boat? Have my clients missed the boat and the growth in Berlin? Well, we absolutely don't think they have. We've slightly changed our focus on where we're buying and what we're buying. But to be honest with you, I would still buy a property in central Berlin. Sadly, I probably can't afford one. But I still think there's going to be some very good growth in central Berlin. But Jeremy's going to just jump on Google Maps now and talk you through a little bit about where we've been buying and talk to you about what we're buying today and where we still see a lot of value.
So you assume you can see the screen now, can you, with the map? Great. So obviously, yeah, as Germany as a whole, this is Berlin right on the east, and then Leipzig just an hour south of it. But say going into Berlin, just as a representative example of, you know, what we've been looking at effectively in the last 10 years. And so we can see these orange stars. These are our past projects we've invested in over that time, and so kind of come to the completion, and a couple of those are still waiting to complete in the next couple of years. But because of this success story, you know, what we've been doing essentially is, you know, we started very centrally in market there. So, you know, in Mitte, which means middle, you know, it's where a lot of the central areas, the central politics and the kind of business district and so forth. You know, a lot of the things we first started in were in the centre there, or going to the west, which was traditionally more moneyed area of the city. And then kind of as years gone on, actually as redevelopments happen, we've been kind of further migrating, looking for that value. You know, we used to, you know, 10 years ago, we could buy properties in the heart of the city here at maybe, you know, 6,000-7,000 euros a square metre. And frankly, you can't touch anything there in new build for probably less than 12,000 now. So, you know, it has been an extraordinary, you know, change there. You know, and fundamentally, we still think it's a very secure market. But, you know, would we buy there, you know, with this booming population and lack of property, would we buy there at that price when actually we can still buy, you know, much cheaper assets a bit further out? And so there are quite a few different areas we would consider overall, but effectively we want to be following the movement of people. So actually where we have now in market is just down here to Köpenick, and this is following the River Spree into the city centre, and this essentially is going to be 20 minutes back into the centre of Berlin on a U-Bahn, on the underground basically system that they use there. Actually, why we like this area overall is because it's, you know, accessible to about 20 minutes to the city centre, but it's a very established residential neighbourhood already. But it's got some great employers kind of around it. There's the science park of Oldershof. There's the Berlin airport is just down here to the west, and Tesla's Gigafactory is just down here, down to the east. So that's probably about a 20-minute drive. So you might get a lot of well-paid high-end engineers and so forth, and people at the science park and people at the airports so it's very attractive for locals to live in, and it's very well connected. So in terms of value, this is exactly where we want to be looking, because we put in high-end new build apartments for around about the 7,000 euros a square meter now. And we can see from their equivalent, say, Rightmove, the amount of interest going into this area has absolutely spiked over the last 4 years, and so the average prices people are looking for and the amount of rental properties people are looking for now, it's gone up by an awful lot. So our latest property is here, into the town of Köpenick. It's actually in a very established residential street, as you can see. It's actually this plot here. So these two buildings are existing structures which are being renovated, and this gap here is going to be new build. So it's all 1 and 2 bedroom apartments. But as you can see, typical German, nice looking property there, very attractive for the locals in terms of renters. You're not going to have lots of other stuff built up around it. It's already established. And then you've probably got a 3-minute walk to get to the S-Bahn line here. And that's going to take you back to the center of Berlin in 20 minutes from the upgrade on the rail line there. So let me go back to the presentation slide. And this is the property as it will look to CGI's. And these are the 2 existing properties which are in refurb, and this is the new build sector, and then it'll be landscaped in the middle there. So this property is going to deliver.
I mean, Jeremy, Köpenick, I'd probably describe Köpenick, having walked around it, a bit like Richmond. It's a wealthy suburb. Lots of young professionals want to live there. It's a good part of town, but you're still able to buy here at under 7,000 euros a square meter. And when you're having to pay 12,000 to live centrally, there's a really good investment case here. And again, the commercial links to the local economies in Brandenburg, to Tesla and everything. You've got the kind of best of both worlds. You've got the demand for people that want to live here to go in centrally, and then you've actually got the workforce that are living and working in the Brandenburg state as well.
Mm. And it's not a fringe area which is being redeveloped. It's a very established, like you say, the comparison to Richmond, in my mind, is good. It's a very middle class area there. People have good jobs and so forth, and it's already very well developed. So it's a case of exactly picking up the value as it's in its growth stage. And with many of our properties in Germany, the finish is very good. We're looking for nice, clean, good square units, nice floor-to-ceiling windows, and a lot of them will have underfloor heating and all the amenities you'd expect for a high-end modern apartment, which really does propel the highest level of rents in market.
So we talked a lot about Berlin because we love it, obviously, but we also love Leipzig, which is the fastest growing city in Germany, has seen the economy double since the year 2000 and predicted to almost do that again. I think it was 72% over the next sort of 15 or so years. Predictions from Oxford Economics. So we'll just spin you through I'm conscious of time, Jeremy. We've taken 40 minutes, but just to briefly go through things here. You can see population. You can see there, 475 residents as of the year 2000, and you can see that by 2021, that's come up to 600,000 residents. And it's predicted to get to over 700,000 residents by 2040. So clearly, we've got a growing population and we've got a growing economy. Red Bull have invested in the football club. It's been called Leipzig. It is a big growth market for the country. There's 5 economic clusters that they have focused on to sort of rebuild this economy. Massive healthcare sector. 45,000 employees working in healthcare. And since 2005, that's basically doubled. Logistics is huge. Notable employers are DHL. They employ about 3,000 people in the city. Amazon, 6,000. And it's actually the one of the largest freight hubs in the whole of Europe. So it's big on logistics, big growth there. Media and creative has played a part. You know, 62% growth since 2005, 35,000 odd employees in that sector. And then very famously, they build BMWs down there, and they built the beautiful Porsche 911 down there. So, you know, there's a lot of industry linked to cars, and a huge amount of jobs in that sector, and a lot of businesses related to that as well that are in the city. And there's a very famous engineering college that has close links to the automotive industry, and there's a very famous finance college as well. That just gives you another perspective probably on the growth I've already discussed. Any comments there, Jeremy?
No, I think we talked about kind of overall the expectations for GDP growth, some of the highest, and there's a very similar pattern here to the one we saw in Berlin. You know, going back to the early millennium, you know, in the 2000s, just almost 21% unemployment, and then because of this rapid change in economy, the unemployment's been dropping and the average household income has been going up, and so actually we're expecting to see a 3.5% unemployment rate here in Leipzig, which is incredibly low for any European city. You know, we're hovering around the 5% mark now, and yeah, you know, it's exactly what we want to see for an environment for investment.
And it's only about an hour and 10 minutes on the train from Leipzig straight up into Berlin. So potentially also commutable for young families if somebody's working in the capital, but living on obviously a cheaper rent or a cheaper home cost in Leipzig.
Yeah, and that Brandenburg Airport, which is just south of Berlin, obviously a lot of Leipzigers would be using that as their major international airport. So that's going to be about 45 minutes away. So that's, you know, very close. Some of the major players, supply and demand, just like in Berlin. You know, we're tracking here the most properties that have been delivered in the last, you know, 10 years and seeing if they sustain that level, where would the undersupply be? And so this is a kind of a very generous view of where they could get to, and we're still, you know, 20,000 homes deficit, even if they keep up with essentially a relatively unachievable figure going forward. So it's for investors, it's music to our ears. If you're a local trying to get nice cheap rents and so forth, it's not the best news in the world, but you know, it's the dynamic of the market.
And like every city in every good city, it's difficult for us to get opportunities, and that's even more so in Germany, because there's very little, you know, there is still not big developments going on in Leipzig. You know, there aren't big towers being built, so we're generally, you know, desperate to find stock, and there are small, you know, smaller schemes that we're getting into there. So there's just not enough being built, which is great, but also frustrating if you want to buy there.
And you could argue, I suppose, here with the last 5 years performance for Leipzig at, you know, almost 6% and rental growth of, you know, 4.6, that, you know, with Berlin having exceeded that in the last 5 years, that, you know, could argue that Leipzig has the extra value here. Basically, you know, it's you know, it's 5 years behind Berlin in its growth spurts, basically. So, you know, for what the city they dubbed mini Berlin, being able to get in at, you know, 5,000 euros a square meter in the center of the city, you know, that's it's a safe play.
And that's the key thing. We are buying centrally in Leipzig now, so it's a little bit like what we were buying in Berlin 8-9 years ago. You know, we're sticking centrally. That's where the growth's going to start, and that's where we're buying. So I think the furthest development out we've probably done has been about 4 kilometers from central, because we can still get some value there. And this is an example. This is the boulevard. This is a little infill plot, actually. And this lovely little building is going in. 12 apartments, mixture of 1 and 2 beds. You can see on the map here, it's literally about 1.5 kilometers north from the central station. You can jump on the tram into town very easily. So really good commutable area.
It's about 5 minutes to get into the centre of town here. So this city centre is one hub of the city centre where you've got some of the universities, and it's a very arts-driven city as well. Actually, it's a lot of classical music history and so forth there. But, you know, a lot of the major plants, like you'd imagine with BMW and Porsche and so forth, is very disparate. You know, it's spread all over this city of probably kind of 12-kilometer radius, and so you do have some finance and some you know, interesting jobs in the centre, but there's big companies spread all over. So, you know, people for lifestyle might want to kind of hop in, be on the tram, be in 5 minutes into the city centre, but they equally might be kind of getting a tram or bus kind of further out to their jobs here.
Exactly. You'll be looking at sort of 15 or 20 minutes to all the major employers that we described: Porsche, BMW, DHL, Amazon. you can imagine they're not in the center, they're kind of in the periphery and in the suburbs. Right, Jez, you're going to pull up a returns model. This all gets very complicated. Jeremy's very good at explaining it, but we were just going to talk you through why we recommend buying in Germany.
Well, most people will be familiar with our basic cash flows and people talking about their, the costs involved with the process and so forth. And, a lot of people will be relatively self-explanatory, and we're happy to have kind of sessions with you if you want to kind of look at these in depth in terms of when the costs come and so forth. But we thought we'd just highlight actually on the second tab, we have here the 10-year projections for growth. So these aren't our projections, of course. We look at the major consultancies in market and people doing the biggest reports on market. So, and this one happens to be for Leipzig. This is Jones Lang LaSalle giving their 5-year forecast, and so we take their estimations for capital growth and rental growth and then discount them as time goes on. So as in, we pragmatically think that as a market grows, its growth level will probably shrink over time. So we're actually taken their figure and then discounted that by 5% each year as the market grows, just to be slightly on the cautious side. But happily, with that being said, this property happened to be a 2-bed for 375,000, but with the growth expected, at the end of year 10, we're cumulatively looking to have just under 80% capital growth. So the property will be worth 673,000. But of course, that's not what the clients invested. The clients probably put in, 35% deposit plus their, initial cost. So when you buy and come to hold and sell in 10 years, when that capital gains initiative kicks off, then you really come to reap the reward. So, if we buy and sell then we're not going to have to pay the capital gains. We're not going to have to pay the selling costs. And it's really, really efficient. So in relation to that initial deposit, it's an 11.5% IR, internal rate of return, or 170% return on equity. And that 170% is basically calculated by saying all the capital growth over 10 years, and all the rental income over 10 years minus all the costs, all the running costs, all the mortgage, all the setup and selling costs and so forth. So, net, it's one of the best returns you could find because you're paying basically nothing in income tax and basically nothing in capital gains tax when you come to sell. So if you did have taxes on that 170% figure is probably going to look like 120% or something. So it's a massive boost to your overall returns, and a very strong reason why people should think of this as a 10-year investment. Buy, forget about it, let the market run for a decade, and then consider when to sell when the 10-year clock comes around.
Yeah, and it's just very, very powerful. We're not applying crazy figures here. 7 and 6 and 5% growth annually compounded is how you get to these kind of figures, and that's what we want to do. We want to get into cities that have this potential. We're not saying that every year they're going to see this growth, but over a 10-year period, this is all very realistic in terms of what could happen here. And we've seen
growth is a relation to the property cycle, isn't it? Overall, really. So what we're seeing in an inflationary environment at the moment is high rents. Like we've seen plenty of times in the last 5 years where rents kind of incrementally creep up, but now they're absolutely booming. Prices most places probably are staying relatively static, but every time we've seen this, what we will see is that rents will go up, make the yields more attractive over time. It's a bit more positive for your property cash flow, and then as the mortgage rates start to decrease, you'll get everyone who's been waiting start to pile into market again, and we'll see another price boom. So if you're buying a property for 10 years, it will go in peaks and troughs over time as that market evolves. But when JLL or PwC have a prediction of an average growth, I mean that's essentially what they're meaning is the mean over a decade holds, and that's how our clients should be thinking about it. But please, if you do have questions about anything we've talked about here, feel free to drop it in the Q&A box you've got there. We're happy to kind of have
one,
sessions.
Are you concerned about the changing political situation in Germany as the right-wing party AfD is coming up?
Yeah, to be fair, that's not an unusual question. You know, and I think, I mean, look, let's forget anyone's personal politics, because everyone can have an opinion about what that means and how people like that or not. But fundamentally, all the same questions were being asked of the UK property market when we did Brexit. You know, back in 2015, thinking, right, we're going to kick everyone out, it's going to collapse the economy and so forth. And again, whatever you think about that is neither here nor there. But you know, in terms of the macro fundamentals, the market has a vast undersupply of property and an upwardly mobile market. And so, whatever political party tends to be in power, unless someone vastly socialist comes in and tries to build 500,000 new homes across the country, which they don't have the money for, then they're not going to solve that underlying issue for the country and opportunity for us.
Germany
Yeah,
has accepted a lot of migration in the last sort of 20 or 30 years. It has a growing population, and it's part of the investment case. So I don't see that reversing, but it could slow. But I guess there's political instability at the moment everywhere.
Yeah, that whole right wing thing is not a German
Yeah.
exclusive issue. That's happening all over the Western world, and you know, we'll see where that lies, I guess, in the future. But you know, on a macro sense for investments and economy, people still want to be buying where there is success and where there are jobs and putting their money into those places. And so we're not fundamentally likely to see anything change in that sense. But yeah, like most developed markets, you just need to build a lot more houses, and you know, whatever developer initiatives they can put into market, it's not enough to kind of curb rising rents and rising prices.
Yeah. Just to finish off, thank you for coming. We have a full management service. We manage the properties that we source for our clients in Germany as well. We help with tax submissions, we help with mortgages. It's the full service we offer, just like we do in the UK. One question is, what else are you doing in Europe? We have done Portugal. We've done 6 developments in Portugal to date, and we are looking at a new opportunity in Porto. I don't see that changing too much. I don't see us going into many other countries for now. We see good opportunity in the east of Germany. We see good opportunity in Portugal, and we still see very good opportunity in the UK, because we do think the market will bounce back very strongly as inflation begins to slow and rates will settle and then drop. Another question, maybe just finish this one, because I can see a few people dropping off. Are these German investments fully set and forgot investments for clients? Property man. Okay, I've just answered that. Yes, they are, really. We do everything, and it's an English service that we provide.
But we do stay in touch. You know, like with our clients, you know, there'd be you know, you could every 18 months to kind of reassess the market, see how things are going. But you know, Germany very much lends itself to, let's just get a tenant in there, or you know, numbers of tenants over the years, and you know, people in Germany tend to stay in the property for a couple of years at least. So, but yeah, the ideal scenario is for them to kind of buy and hold, and yeah, the lettings team and our representatives will be there to keep updating them, and so they're not on their own.
Yeah, and Ben's asked a question. Thank you, Ben. The 10-year capital gains tax, could it be revoked? Very, very unlikely. They do like long-term investment in Germany. It is an encouragement, and it stops the market sort of people flipping properties. It is quite a security thing by actually encouraging people to hold property for the long term. I think my only comment would be, if it was changed, it wouldn't be reversed backwards. You know, it would be from that date onwards. And we saw that in the UK when they did that change with non-residents, that your tax to date until the announcement of the law change was your gains were all yours. It wasn't sort of backdated, if you like.
Yeah, ongoing, that would be the thing. But yeah.
Very good. Well, thank you very much for joining us. We'd be delighted to hear from you. We'd be delighted to speak to more of your clients about what we do in Germany, because it's very interesting. So thank you for your time, and we'll see you hopefully on another webinar very soon.
Thank you very much, guys. Cheers.